Welcome to More Wealth Retirement Talk with Shawna and Dave Moore of More Wealth Management. Retirement planning comes with unique challenges like managing market volatility, staying ahead of inflation, and building a strategy that aligns with your goals. On this show, we'll tackle your biggest financial concerns, share actionable insights, and explore strategies to help you navigate your journey to retirement confidence. Now let's get started with More Wealth Retirement Talk.
Hello, and welcome to More Wealth Retirement Talk. My name is Shawna Moore with More Wealth. And if you'd like more information about what you hear during our show today, give us a call at 833-4-MY-WEALTH. That's 833-469-9325. Or you can visit us online at morewealthtalk.com. That's MOORE. wealthtalk.com. While at our website, you can click on the radio page. You can check out our past shows and subscribe to our program on either Apple Podcasts, Spotify, or Amazon Music. So many people think that investing is only something you do during your career when your goal is to pile up enough assets to help you retire and enjoy your preferred lifestyle. But in truth, there's no reason you can't keep investing after you fully kick back and embrace the retirement lifestyle. After all, the more you grow your finances, the better off you're likely to be, even in retirement. But before we get into this topic, let me introduce my co-host, Tony Shore, who we will always keep investing in because he is just so essential to this show.
Flattery will get you everywhere, Shawna. That's for sure. That's for sure. Now, this topic does sound like a really, really good one. I mean, I've always assumed we're supposed to stop worrying about investing once we've retired, but it sounds like I'm about to be proven wrong, right?
Yes, you will be. And so I'm going to kind of go off of a recent Forbes article. Here's why you should continue investing after retirement, because it does present an interesting perspective. And we've experienced some of this with some of our clients as they retire and want to potentially get out of the market 100%. But, first of all, retirees should view themselves as long-term investors. Retirement isn't a finish line. It's a whole brand new chapter for you, the next chapter of your life. So even if you retire, say right on schedule at the age of 65, your journey is far from over. In fact, you might have 30 years or more of life still ahead of you in retirement. And a recent study from JP Morgan noted in the article found that a healthy non-smoking couple has a 46% chance that one of them will live to age 95. And there's a nearly 1 in 5 chance that they'll reach 100. Which might seem like a long time, but that's not just longevity, that's an opportunity. But here's where things get really tricky. When the paychecks stop and you start drawing from your savings each month, it's easy to slip into a short-term mindset. Understandably so, because monthly expenses don't take a vacation in retirement, but still this can cause many retirees to see themselves as short-term investors, even though they're only tapping a small slice of their portfolio each year.
Yeah. Yeah, I think that's important to note. And I really like how you put that. So then what's the move here? What do we need to do?
Well, the truth is, again, most retirees are still long-term investors, and there's real power in embracing that correct perspective. And that's what it's about. So first, it gives your portfolio room to breathe. You can weather the downturns and bounce back over time, like we've seen recently. Just as important, it helps you stay focused on the long-term game, making sure your investments continue to grow and keep pace with inflation so that your money works as hard as you did. Retirement may mark the end of your career, but it's also the beginning of your legacy. So you should plan accordingly.
Yeah, and what better way to plan accordingly than by working with somebody like yourself, Shawna, a trusted financial services professional?
Exactly. And that can give you the confidence to continue to invest in the market rather than kind of stay on the sidelines for safety.
Sure.
The article also tells us that stocks maybe, they offer needed returns that you might need in retirement because of inflation. So when you're investing for the long haul, time becomes your greatest ally. Over the span of, say, 30 years in retirement, or the last 30 years, the market has rewarded patience in a big way. So when you look at it, since 1977, U.S. stocks have delivered returns twice as high as ultra-conservative T-bills, according to data from Portfolio Visualizers, which is also shared in the article. If we look at a 15-year rolling period going all the way back to 1928, the story stays the same. Stocks have averaged 9.8% annually, while T-bills lagged far behind at just 3.34%. And when we look at recent inflation, 3.34% is not going to cut it when you have inflation that could be 4, 5, 7, 8%. Yeah. So it's not just a difference in numbers, it's a difference in outcomes. And let's be honest, stocks do come with more ups and downs. We've unfortunately seen a lot of that this year, especially in the last couple of weeks. But during the past 50 years, their volatility, which is measured by standard deviation, was about 5 times greater than T-bills. But here's the key. If you see yourself as a long-term investor, you don't have to fear the waves. You learn to ride them.
Yeah. Yeah. And I think that's another great point that you make. You don't have to do it alone either. That's the good thing, isn't it?
That's exactly right. So a thoughtfully built, well-diversified portfolio that you build in closer partnership with a financial services professional can smooth out much of that ride and take away a lot of those emotional decisions. So take a classic 60-40 blend of U.S. stocks and T-bills, for instance. That mix has shown a standard deviation about 40% lower than an all stock portfolio, meaning less turbulence without giving up all the journey's rewards. So the bottom line is that volatility is part of the price of admission, right? But with a long-term mindset and the right mix of investments with the help of a professional, it's a price that could be well worth paying.
Yeah. Well, and how does inflation factor into all of this?
Well, inflation doesn't knock on the door. It quietly slips in and makes itself at home, right?
And inflation, the silent killer, right? That's what they call. Yeah,
exactly. So for retirees, it's one of the sneakiest and most dangerous threats to long-term financial security. Over 30 years, even modest inflation can dramatically reduce your purchasing power. So what seems like a small year-over-year increase in price adds up real fast. Sometimes inflation doesn't move quietly at all. Like I said a minute ago, just look at 2022 when prices jumped sharply in a matter of just months. Or think back to retirees in the late 1960s who faced the relentless inflation of the 70s and early 80s, which was a tough time to stretch on a fixed income.
Yeah, it sure was. So how do you invest your hard-earned savings then?
Well, the goal is to have your money grow faster than prices rise, correct? So that means leaning into investments that have historically outpaced inflation. T-bills, while very stable, often struggle to keep up. Stocks, on the other hand, have shown strength over time, delivering long-term growth that can help you preserve your lifestyle, not just your capital. And, your bond allocation, well, the article explains that tools like TIPS, which are Treasury inflation protected securities, can be a smart addition. There's a lot of other types of options as well that are designed specifically to rise with inflation, helping you maintain real purchasing power even when prices climb.
Okay. So I know as we're talking about this and you're giving us all this information, Shawna, our listeners probably have questions, or they may want to get a plan in place so they have something in writing set for retirement income. Maybe they're already in retirement and they want to make adjustments, want to know what to do. How can they get a hold of you?
Well, listeners, they can visit us on our website. Again, that's morewealthtalk.com. That's MOORE, wealthtalk.com. They can also visit us, give us a call at our office. That number is 833-4-MY-WEALTH. It's 833-469-9325. And we can discuss and, answer any other questions, address their concerns about investing during retirement, their overall retirement goals, or any other parts of their financial strategy, including an actual written income plan that will take into account their investments and so forth. And so it's our goal to help you prepare for the retirement that you've worked so hard for.
Yeah. And I think that's great, Shawna. You're offering that no charge, no obligation consultation. And you've been telling us how for a lot of retirees, the smart play is to keep investing rather than just hunkering down with the assets they already have. And it's been a good conversation so far. What's next?
Well, the Forbes article, again, it's here's why you should continue investing after retirement, has a lot of additional information that I think is worthy of everyone's time. It next addresses a very interesting question. How much should you invest in stocks before you retire versus after retirement? And your investment mix shouldn't stand still because your life doesn't. When you're just starting out on your journey to retirement, time is on your side. And that's why younger investors, those with decades ahead of them, they can often afford to lean heavily into stocks. A 90-10 split between stocks and fixed income isn't unusual, according to the article. In fact, some long-term investors go all in on stocks during the early years of savings. The article even adds that Warren Buffett in 2013 to his Berkshire Hathaway shareholders, they suggest a 90% stock and 10% bond allocation for long-term growth. You might ask why? Well, because when you've got time to ride out the ups and downs and capture the market's long-term gains. But as retirement draws near, and especially once it begins, it's time to shift gears.
Yeah. So here's a big question for you. How much should you keep in stocks during retirement?
So the answer isn't a one size fits all, but research can help guide the way. So the article explains that back in 1994, Bill Bengen, the father of the traditional 4% rule, found that portfolios holding 50 to 75% in stocks produce the most sustainable withdrawal rates over time. Why not go higher? Well, because history has shown us what can happen. A retiree sitting in a portfolio that's 100% stocks during a 1929 style crash, or we saw it in 2008, not as severe, but you can see your nest egg fall, if it was during 1929 style crash, 90% in 3 years. On the flip side, going too conservative, less than 50% in stocks, can leave your portfolio vulnerable to inflation like we saw in the 1970s. The article tells us that's why the 60-40 portfolio has become a classic. It aims to walk the line between risk and reward. But let's be honest, the right allocation is the one that fits your goals, your lifestyle, and your financial peace of mind, and what you're really, truly comfortable with. Because retirement isn't just about numbers, it's about confidence, freedom, and waking up each day knowing you're right where you need to be.
Right. And is there ever a point where a person should simply stop investing in stocks?
Well, not every retiree needs to invest in stocks. But some may still want to. Let's say, for example, you're in a fortunate position. You have Social Security and a pension that cover your lifestyle comfortably. And we have clients in this position all the time. So you're not relying on your portfolio for monthly income. In that case, you might reasonably choose a more conservative approach, investing primarily or even entirely in fixed income. And for those in the later stages of life, preserving wealth may take priority over growing it. But here's where the article gives us a twist, and this is what we talk about with our clients often. Those who don't need to take risks may be the best position to embrace it. If you can weather the market's ups and downs without needing to draw from your investments, you're in a very powerful position to capture the long-term growth potential that stocks historically offer. In fact, over time, stocks have consistently outpaced bonds, sometimes by a wide margin. So this can open up an opportunity not just for you, but those you care about most. And what I'm talking about is legacy planning.
So how can working with a financial professional like yourself, Shawna, help retirees with their investments then?
Well, again, retirement doesn't mean stepping away from the stock market. It just means approaching it with more intention. So a skilled financial services professional helps retirees or their clients invest with confidence by aligning their portfolio with their goals, lifestyle, and their comfort with risk. So for many retirees, the market can feel intimidating, but a good financial services professional brings clarity. We help you define why you're investing, whether it's for growth, legacy, or simply to keep pace with inflation. And from there, we can craft a diversified portfolio that balances growth potential with downside protection. We can also guide your income strategy. That might mean using a bucket approach, building a dividend stream, or planning dynamic withdrawals so you're not forced to sell stocks in a down market just to meet your income needs. And we stay steady when emotions run high. So markets rise and fall, but panic is optional. And a good financial services professional serves as your sounding board, your strategist, and sometimes your emotional anchor, helping you stay focused on your plan when headlines or market swings try to pull you off course. So ultimately, we're not just managing your money, we're managing your financial peace of mind. So with a solid plan, you can continue investing in stocks, not out of fear, but with purpose, knowing your money is working for you, your lifestyle, and your legacy.
Well, this has been such a great conversation. I mean, we're talking about why retirees still need to be active in the market even after they officially retire and the benefits there. There are a lot of ins and outs to this, and everybody's situation is different, isn't it?
Right, exactly. And I guess the bottom line is really making sure you're working with a financial professional who has your best interest in mind, someone who is independent and can offer the different types of investments that are right for you. Or if it's, safe income, there's different options on the insurance side, and just really making sure that your best interest is at their heart and that you have that working relationship, someone you trust, so that you're not making those emotional decisions in the market. And from there, then you can make the most of your retirement.
Yeah. And again, the key here is, and the bottom line is, have a plan in place and don't make a move without working with a financial professional. It's so important. You don't want to make expensive mistakes with your retirement income and your planning. Shawna, I know you're offering a no charge, no obligation consultation to help people with that and get a plan in place or give them a second opinion on where they're at. How can they get a hold of you?
They can call our office. That number is 833-4-MY-WEALTH. That's 833-469-9325. They can also go to our website at morewealthtalk.com. That's MOORE, wealthtalk.com. They can get some additional information, listen to past shows, and then they can submit a request online for that complimentary consultation as well.
All right. Well, thank you so much, Shawna. And listeners, thanks for tuning in. That does it for today's episode of More Wealth Retirement Talk with our host, Shawna Moore.
Thank you for joining us for More Wealth Retirement Talk. Don't head into retirement without a strategy that addresses both income and taxes. For more information, please contact Shawna and Dave Moore at More Wealth Management at 480-800-7077 or visit morewealthmanagement.net. Join us again soon for another episode of More Wealth Retirement Talk.
Advisory services are offered through More Wealth Partners, LLC, a registered investment advisor in the state of Arizona. Insurance products and services are offered through More Wealth Management, an affiliated company. More Wealth Partners and More Wealth Management are not affiliated with or endorsed by the Social Security Administrations or any other government agency. All matters discussed during the show are for informational purposes only. Each individual situation may vary, and the opinions expressed here may not apply to everyone. Materials presented are believed to be from reliable sources, and no representations can be made as to its accuracy. All ideas and information should be discussed in detail with one of our qualified representatives prior to implementation. We are not affiliated with or endorsed by the Federal Medicare Program or any other government agency. Calling this number will direct you to a licensed sales agent.